This was the trade. Now, it was a paper trade for the purpose of my teaching, because I want to make this clear. I am not offering any kind of financial advice whatsoever. All right? No financial advice. This is purely for educational purposes. And therefore, I am only going to be showing you paper or demo trades, depends on what platform I'm working on. If you can't handle that, that's fine. I'm not trying to make a name for myself as the next hotshot trader. I've been doing this since 2007. If you learn, you learn. Good. So the setup is my bread and butter setup. I've been doing this now for years. Shout out to Michael Huddleston, ICT years ago. One of the first few guys who got onto him before he became mainstream. This was back in the early days when he was on Baby Pips, before the new stuff that's come out recently. It's based off what he would call a 4-hour turtle soup. And so this is what I do. I'm going to put on my weekly and daily separators here. And so this, let's put this off the screen. These dotted lines are weekly separate. No, these are the weekly separators. No, hold up a second. These are the monthly separators, and these are the weekly separators. So this is a 4-hour chart on TradingView. Now, I'm going to take this off to walk you through this from the beginning. Now, ideally, you would go to the daily chart and map your daily and weekly levels and all that, but I'm going to assume that either you know how to do all that, or we're just going to assume that I've done that already, which I have, right? And that we have a daily bias that we think lines up well with what we're doing on the 4-hour chart. So when a week begins, and this was the beginning of the week here on Monday, this line there, when the week begins, we're going to look for the first sweep of a clear swing high or swing low. The first sweep and reversal. Right? Now, let's get this out of the way. So I'm just going to build this trade idea straight from the start. I'll get this out the way as well. So this is what your chart would look like. 1 second. Okay. So this is what your chart will look like if you come in blind to TradingView. These dividers are there strictly because I want to show you that this is where the week began. Now, the week starts here. So this is what you see when it begins. Where is your last swing low and swing high? This would have been the last swing high here. This would have been the last swing low going into the new week. That's the last swing high there. That's the last swing low there. Okay. As the week moves, we take out this swing high, this one right here. We also take out this one, right? And then there is a reversal. That is a valid trade. As you see here, the 4-hour reversed. If you waited for the pullback, 1 second. By the way, I'm an old MT4 trader. I've only recently, in the last few months, with a break in between, I did TradingView for about a month and a half, and then I took a 3-month break, and I'm back. So if I don't use it very well, just forgive me. I'm an old dinosaur trying to adapt. Let's assume you caught this pullback perfectly here, and you were to put your stop loss there, and you were to have gotten out at this swing low there. That would have been a 3.46 risks to reward ratio. Not bad. You could have dropped down on the 15-minute chart to refine your entry. All right, so let's do it this way. So on the 15-minute chart, this would have been the market struck shift. So I'm trying to use your new terminologies. What we learned back in the day is different from what you guys are learning now. We would have called that a market structure break. You call it a market structure shift or change of character, sorry. So 15-minute chart, the 15-minute and the 4-hour go very well. We take out that high there. There's a 15-minute breakdown to this side, and there's a retracement. We're going to pull that retracement into a Fibonacci tool, right? And as you can see, it comes up nicely to the 618. And then here, you could basically just have taken the trade there if you wanted to. Pretty much there on this, but as you can see, it goes all the way up further back there and gives a nice reversal there. Worst case scenario, if you waited for this to get in, if we shift that there, even if you put this all the way up back there, right, you are still looking, 1 second, let's show the R to R. Let's go back to a 4-hour chart to show the R to R. You would still be looking at 2.7, roughly 3 to 1. Not bad, right? You don't go broke consistently doing 3 to 1. However, and this is the key point, just by looking at the 4-hour chart, it should be clear that we are in a long-term bullish environment. Price has come all the way down there and has rallied, taking out this swing high and then forming this one, pulling back and then taking it out again. So what you should be thinking of, and I'm doing this with no volume analysis for now. This video is not going to show any volume analysis, just showing raw price action. This pulls back, pushes up. Just looking at this for a second. Now, market's been coming down, then it pushes up, right? Breaks structure there, changes character there, and there again. This should have been something you would have been looking at. Also, if you go, well, this is where the daily chart comes in. Let's go to a daily chart. And then you see this even more clearly. Right, so price comes down into a level. What's behind here in history, we'll look at that some other time. But there is a clear change of character to the upside. That's a swing high. We dip beneath it, right? Well, not change of character here, sorry, just a reversal, actually. This is a daily engulfing. This candle here is a significant daily engulfing. So you would kind of expect price to carry on for a while. And where would you expect it to go to? Well, what do you know? You have a bunch of fairly equal daily highs over here. I'm just going to throw that line across and you'll see how the original trade idea lined up. So, okay, excellent. So basically, that's where the top line you saw earlier on in the video came from, right? So I'm of the opinion, based on this engulfing here, that price should reach and take out these daily highs. Also, you will see, right, how do I draw this now? You will see, this is where my not so great trading view skills come in. I'm trying to draw an order block and I have no idea, can't even remember how to do it. All right, we're just gonna have to, let's see. How do you draw this thing again? You know what? We'll do it this way. So No, I don't want array. Anyway, this order block here, right? This order block right there. If you were to pull it across the screen, you would see that this equal high is nestled perfectly in there. Can't believe I can't remember how to do this again. Anyway, I was messing around with it a few weeks ago. So that's our target based on this engulfing here. That's pretty much the trade idea. There's an engulfing there. I expect it to get there. Good. So we drop back down to 4-hour chart to show you how the trade was analyzed. So this has happened. The week has started, like I said, in the direction we expect price to go in long term. We're looking for a turtle soup in that direction. So this here, this is an intra-week low. This would have worked just fine. This here would have been just fine. Okay. I'm drawing rays and I don't want to. Okay, that's why. So this low here would have worked just fine, in that we want to see price sweep that low and show us bullish momentum to the upside. However, I particularly like taking a previous week's higher low. So this for me is an even greater confluence signal. There's a previous higher low from the previous week. In this case, it's a low because we're going to the upside. Now, the question is, how do we define a bullish move or an impulsive or momentum bullish move? Well, first of all, you notice this consolidation area here. This is gold. One of the things you want to see when price is, for instance, this is another thing happening here. There's a consolidation forming here. When price gets to a level of interest, you want to see a contraction, a consolidation, an accumulation of orders. It means market makers and institutional level traders are accumulating orders on both sides. So the fact that on a 4-hour chart, we can see a consolidation deepen into this level is good. Also, at the start of the week, you would expect 60% of the time, 70% to said you want to see a consolidation dipping into that level and then a nice reaction. So I was talking about that I trade in with four time frames at every time. I have a directional bias time frame for this setup. It's the 1 hour, it's the daily. I have a signal time frame, that's the 4-hour. I have an execution time frame, which is the 15-minute, but I have a confirmation time frame, which is the 1 hour. You really don't need the confirmation time frame. You can go straight from 4 hours to 15 minutes. I just like to use a 1 hour just to give myself a bit of extra comfort because I am naturally a risk-averse trader, and I wasn't always that way. But when you do this as long as I have, you almost likely will become one. All right, so so we then go back down to the 1 hour time frame. So again, like I said, this is a confirmation of the signal. This is the level we're working off. That's the level we're working to. In essence, taking a trade should be like taking a bus or a train or a plane. You're simply asking yourself, where is my departure station? Where's my arrival station? Now, let me rephrase that. Where is the departure and arrival station for the trade? Now, where you get in on the way is different. You don't have to get in exactly at the arrival, at departure, and you don't have to get out exactly at the arrival. In fact, trying to do that is a recipe for disaster. If you try and pick tops and bottoms, you will usually, because I mean, the most precise way to have gotten into this trade would have been to set a limit order here and a stop order there to get out. But we don't know. Now, it looks beautiful in hindsight, but we don't know for a fact that this is what was going to happen. Let me show you what I mean. If you wanted to be very bold, like very, very, very bold, this would have been the entry to make. You get in on the top of this, right? In that case, I would have put my stop loss just under this low down here. My take profit would have been on, and that would have been a 3.621. Not bad, right? Not bad. With very little drawdown. I'm going to show you how I beat that risk to reward ratio without necessarily getting in there. All right. Okay. So what am I looking for in a 1 hour chart? Well, confirmation. I want to see displacement, right? Displacement. I usually want to treat this. I want confirmation that this swing low there is the beginning of the move up, because that's where I want to put my stop loss. So how do I get that kind of confirmation? Well, there is an hourly engulfing that takes us here, but really on a 1 hour chart, that confirmation is found at that point there. So we form off this move here, right? We form an intermediate high. We form an intermediate high that is then blown through. Let's look at that impulse. It's blown through, engulfing here. So again, you could literally get on this trade there. 1 pip above that high on a stop entry. Put your stop loss down there and go for a ride. Again, you're coming out there. And that would have given you 2.46. Now, this is the purpose of an execution time frame. We're going to go down, and this is what you saw on the screen when we started. We're going to go down to the 15-minute chart. And you're going to see precision at its finest. Now, let's get rid of that 1 hour. Like I told you, you don't need the 1 hour. You can just go straight to a 15-minute chart. And I did take the trade on a 15-minute chart. That's the level. That's the reaction. This here is the exact same principle. We form an intermediate high that is then blown through and reversed. And on the reversal, there is a 15-minute engulfing. That candle there is engulfed by this candle. But secondly, we want to see a fair value gap on the 15-minute chart. That's how we know we can trust this displacement. Look, from that candle there to that candle there is a fair value gap, right? It's a displacement gap. This tells me somebody with deep pockets is trying to get the ball moving there. And as you can see, don't try and be cute. It's very visible. It's not, you don't have to squint to look at it. It's obvious. It's clear. Look at it. It's there. Beautiful. This fair value gap, once it takes out this high, again, 1 pip above there, is the entry. Now, you could enter simply, you could simply enter on this engulfing, right? You could enter on this engulfing there. That also works just fine. I like to use a fair value gap. Sometimes I'll cheat based on how it looks to me. I know you're not supposed to do that when you've taken one setup for years. You just know based off the first sign, and you take the loss if necessary. So, well, I'm looking for a long position. Yep. So we're entering now here. Still putting our stop loss there. But now, okay. Basically, we're coming out at the touch or a pip or two beneath that. So let's put it to the touch. As you can see, pretty much the exact risk to reward ratio, but you have extra information. And you will notice that I have not applied volume profile. I have not, which I do use. I'm an old dog learning new tricks. I'm using volume profile. And if, I mean, well, I'm not going to bore you with that, but I'll just show you one of my, yeah, that's what I'm looking for. So if I just throw that on there, okay, that's the wrong one. I think this is the one I'm looking for. Just tells me pretty much, all I'm going to explain for this for now is that that was a level I should have been considering anyway, right? As you can see, that it's about. Anyway. All right, let's take that off. So that's the trade. And notice what price does when it gets there. It starts dancing around. Let's check what's going on today. Okay, US stock futures. All right, that's fine. Again, this tells you, and notice how it nicks it almost to pip or the point. Now, to be on the safe side, you probably want to come out somewhere here, right? So you want to come out. Give yourself some breathing room, all right? But that's still 3 points. So let's do 3.5 exactly. All right? It's 3.5 in one day. And I know people who would make 3.5% on one trade and stop trading for the week. Because if you do 3% compound, that's a lot of money over the course of a year. And so that's it. That's an example of how simple trading can be when you know what you're looking for. So let's summarize. And of course, let's go back to this other chart. This, as you can see, was the trade. So this was it. That's what. So what did we do? In summary, let's go over this again. And you can do this on any asset class, any day, any platform. Pick 3 time frames. One of them, in essence, you should have at least the 4-hour as your highest time frame. Don't do this using the 1 hour as your direction time frame. You're just looking for noise. But I like it. It goes very well with the daily, right? Just set a bias for direction. How did I set a bias? Well, there's a daily engulfing there. If I was price, what would I do? There's equal daily highs nestled in an order block. If you want, that can be your rules. The more precise your rules are, the less trades you're going to get, but the more refined your entry is going to be, and the less risk you're going to be taking, and the better you'll be. So for instance, you can just tell yourself, look for daily equal highs nestled within a daily order block. And then you look for every single asset class till you see it. So I want a daily, just give an example now. This, you can do this several ways. You could do it as a fair value gap. You could do it as a mean regression. Just on a daily chart, tell yourself price should go from here to there. Where's the here? The here is a daily engulfing. Where's the there? The there is daily equal highs nestled in a daily order block. That can change. Entry and exit points can change on your highest time frame. Fair value gaps, inverse fair value gaps, whatever you like, whatever you like. I forgot what they're called now. Displacement gaps, whatever. But you just mop out, I'm going from here. And so for me, it was I'm going from this point here, basically the point being this engulfing to there. Now, on my signal chart, 4 hours time frame, the signal for this particular system and entry is I'm looking for, in the week I'm currently trading, a turtle soup and reversal of a 4-hour high or low in that direction. The week started here. This would have worked just fine, right? This level here would have worked just fine because you still have gotten in the same way. This is a bit clearer to me because it's from a previous week. And also this is forming in the middle of a consolidation. Train yourself to stay away from price that is consolidating on your signal time frame. Now, a consolidation on a higher time frame could be a trend on your time frame, but on your signal time frame, stay away from consolidations. So price comes in here and you see when it dips below that level, there isn't a sharp reaction. It tells you all you need to know. But when we get here, the reaction is very, very sharp. You can look at a couple, like I said, you don't really need it. Just drop straight down to 15-minute chart. And you also need to know, one of the first things that I learned trading was what time frames go together for signal and entry. 4 hour goes well with 15 minutes. 1 hour goes with 5 minutes, right? And daily goes well with 1 hour. If your signal's on a daily, your entry will be best taken on a 1 hour. If your signal's on a 4 hour, best taken in 15 minutes. If your signal is on the 1 hour, which is the lowest chart I would suggest you use as a signal chart, my preference, your entry is best taken on a 5 minute. Okay, so we drop down there. We see that's the level. There's a nice consolidation. See, price is ranging for pretty much an entire day. And this is something that I will talk about in a coming video on this channel. I've spoken about it on the old channel. I think, if I'm not mistaken, we call them Z days. Not Z days. These are not Z days. These are different. These are just range bound days. Z days are days that manipulate by taking out high and low on both sides. But you like to see a significant consolidation as price approaches the level you are keen of. It's a sign that you're correct because markets move from consolidations to consolidations. Talked about this before, CMERT. A consolidation on a price chart is a sign that you are beginning a significant move. And so consolidation, price dips beneath the level, right? There's a displacement to the upside. We take out a market structure there, change of character. We come back down into it. I mean, you could just have, I mean, if you are risk inclined, like I used to be, this would not have been a bad place to come in just on the dip in here. Why? Because if you believe that this was a change of character at your level, then you just take a Fibonacci entry. Let's put that there. From here to here. No, not you. I want a fib. From here to here. Right? And that's a 618. Right? That's why I said that would have been a good place to come in if you are that way inclined. I'm not. I like to wait for confirmation. And so a confirmation is a fair value gap or an engulfing. So this would have been fine. This would also have been fine. If you took it at the engulfing, meaning once price engulfed and the candle closed, there you go. And you come out a little bit beneath there. 3.6 risk to reward. You'll get this setup at least if you trail 5 asset classes. I go into a week trading anything between 3 and 5 asset classes. If you trail, meaning you're watching them 5 asset classes over the course of a week, there are very few weeks in the trading year where one of them will not give you a setup of this nature. We want quality, not quantity. We are hunters and snipers. All right, guys, see you in the next video.